Hey everybody, I'm Michael Smith. I hope your summer's going well. Well, you know the heat's probably not the only thing making people uncomfortable. Let's talk about the economy. Hey everybody, I thought this would be a good time for a midsummer check-in. You know, this morning I saw an article and I'll tell you, Elon Musk, we know who Elon Musk is. He is one of the biggest billionaires in the world. Someone who's very out there in the media, always giving his opinion. And even he's having a very hard time understanding what's happening, the recipes that are being applied by the Federal Reserve. And quite frankly, I mean, if he's having a hard time, I'm sure many of us are probably having a much harder time. So let's talk a little bit about what's happened currently. First of all, we know that we're about the rally. Let's talk about this market rally. This is one I think has many people confused. And the reason being is it just keeps going. I mean, many people probably hate this rally because earlier in the year, a lot of the bears were getting out. They weren't believing in some of the fundamentals and some of the things that would continue to make this market move higher. So many people were late. That's called the fear of missing out, which is what's happening right now. Well, let's look at where we were. Back at the lows of the market, we're about a 15 times multiple on the S&P 500. Today, we're at a 20 times multiple. So we've definitely have seen a pretty nice rally. As a matter of fact, we're about 3/4 of the way from the previous highs. So that's a pretty good market. However, when you start breaking down the components, it's really been the mega caps. We're just now starting to see the breadth widening. But I think, you know, for many of us here at Avidian, and for what we're seeing, is that we believe that this is probably a market that's probably gone overstretched to some degree. And so one of the things, if you look at the markets today, right now, one of the things that we look at to judge, should we put more money into the stock market? Should we be taking more risk? We look at what is the risk premium right now. So typically the risk premium is you take the 10-year treasury yield, which we all know is very high, it's probably at all-time highs from the last, decade. So we're looking at somewhere in that near, 4%, 5% range on bonds. And then we're looking at, well, what are the forward-looking returns for the S&P 500? And they're just not that compelling. So this is one of the reasons we've been talking about looking at quality stocks, if you're going to have equities, and you should. This is basically not a statement saying get out of equities. That's not what I'm saying. What I'm saying is the quality of your equities probably needs to rotate from the growth to the value, and so you can kind of sit through this next wave. But I also, one of the things I tell you is probably one of the biggest advantages out there is looking at fixed income bonds. For the first time again in a decade, we're actually getting a yield that can beat that of long-term inflation. Long-term inflation is around 4%. You're getting bond yields around 5%. One of the biggest traps I'm hearing right now, and I think this is a good midsummer check-in point, a lot of people are saying, well, Mike, I can sit in money market, I'm getting 5%. Hey, Mike, I can go buy a 1-year treasury, a 2-year treasury, I'm gonna get 5%. And that's fine. There's nothing wrong with that. And I would tell you, for your short-term money, fantastic. However, on a long-term game, look, the Fed is likely probably going to push us a little further. And that's one of the things that I think is been disappointed is many people don't understand, including back to Elon Musk in that article, is the Fed is looking at lagging indicators. So things like unemployment. They're not looking at forward-looking indicators, which that's where Elon basically, and the same thing with us, we're looking at that. And things aren't as strong as they should be. And so the Fed's looking at backward data and applying a recipe to that, which probably indicates they're likely to raise maybe 2 more times, okay? And so that's going to be a headwind for the markets. But bonds right now, if you look at them, go out in the future, that 1 year, people that are trapped in that 1 year and that short-term range, by the time those bonds mature, we're likely to see rates back down. And that's the one thing that I think that many people aren't understanding. They're not here to stay 5% and here to stay 4% forever. As a matter of fact, that is likely to roll over. Good luck with the timing on that, but one of the things we like and we think are very attractive is maybe looking at some midterm to longer dated bonds. This will be one of the first times in a long time that that's a good move in your portfolio. So we've been actually, suggesting that, we've been discussing that rotating into some bonds right now has probably got one of the most attractive risk premiums. So that's probably, for the most part, that's probably the best point I can make for this midsummer check-in. If you're not understanding how to make that happen or how to apply that, obviously, our emails are open, our phones are open. Give us a call. We're happy to help. Thank you for listening to The Lowdown.